Today's Indianomics is on the transformation of Bank of Baroda over the past few years from a relatively ignored stock into a darling of even foreign funds. The current MD and CEO Sanjiv Chadha has an enviable record as a bank MD. When he joined Bank of Baroda as MD in the last quarter of FY20, Jan 2020 actually, the stock price was around 90 rupees. Today, as Chadha ends his term, the price is 190 rupees. In FY20, the bank had managed to eke out a profit of just 546 crore rupees. In Chadha's last year, FY23, the profit is 14,110 crore. The gross NPA then in FY20 was 9.4%, FY23 3.79%. Net NPA then was 3.13%, latest year 0.89%. Credit cost then 1.82%, now 0.4%. Sanjiv Chadha took over when the financial merger of Vijaya and Dena banks into BOB had just been completed, but he had to see through the integration of personnel and extract synergies. Chadha was also taking over from PS Jayakumar, who was the only instance of a private sector banker to become the MD of a PSU bank. In the 2 terms of Jayakumar and Chadha, Bank of Baroda has been noticed for accelerated digitization of services and for a lot else. To discuss how Bob has transformed in the past few years, I have with me the man himself, Sanjiv Chadha, Managing Director and CEO. Good morning, Mr. Chadha. Thank you very much for joining me. Well, actually, that is the first question. You know, very briefly, what are the 2 or 3 things, or maybe 5 things, that has changed in BOB over the last 5 years?
So I think for any transformation, first there needs to be an opportunity, and then there needs to be an agenda. So I think the opportunity was there because, as you mentioned, Mr. Jayakumar had really come in and brought a lot of change, and initiating change is always tough. The second was that there was a merger which was underway, and it is only times of transformation where then you can really give it momentum. Third, I believe, was COVID, which was a watershed, which had also allowed you to do things which otherwise would have been more difficult.
What did you observe over the 5 years as different?
So I think 4 or 5 things. One was, of course, the fact that coming from SBI, I think the central challenge was how do you make sure that you can get talent, because if there was one thing which was different, it was SBI, of course, has a great model, homegrown talent, but what could you do in BOB? And I think it was a very pleasant surprise that that Mr. Jayakumar had initiated that change. We were getting people from outside, and as you progressed, you found that it was actually possible to get first-rate talent bank and to retain that. So I think that was the first element of transformation which was there. The second was technology, which was very important. Now, we had made investments in technology, for instance, through a data lake, but ultimately it's important that technology gives you results, it touches the customer. And there, with COVID, there was an opportunity to actually bring about a very wholesale transformation. That's where Bob World came in. Third was, I think, a performance culture, which is very important. And that's something that we were able to build. Now, if you talk to any of our people and ask them about how their branch, how their zone, how their region is doing, people have again the important performance metrics even at 3 o'clock in the night if you were to give them a call, right? Okay. And the fourth I think is important is again a governance agenda and a strong sense of ethics. We brought in Dr. Mukund Rajan to help us again construct a ethics agenda for the bank, because that is something that really is the bedrock of change that can be sustained. So I think these are 4 or 5 things which were there.
Let me take each of them in detail. One thing you didn't mention, and which other Bank of Baroda old-timers told me, is that you've also introduced, or maybe with Jayakumar, I don't know, a collection mentality. I mean, until very recently, growing the balance sheet used to be the goal, but you gave a lot of stress to collection.
So I think it was really identifying that what were the missing pieces, right? And one of the missing pieces was, if you were to look at what is it that, where are we away from the best? One was in terms of growth rate. Public sector banks have been losing market share. The second was in terms of margins, right? They are lower, which are as compared to others. Third was in terms of, again, the asset quality. Right. Part of the asset quality is, of course, cyclical, and we have seen some of the upside from there. But fundamentally, if you want a sustainable transformation, it is the collection mechanism which needs to change. And what we found was, as compared to some of our competing banks in the private sector, the kind of resources that you deploy for collections, again, were suboptimal. And also, again, it was as a discipline not developed. So among the people that we brought in, we also brought in, again, a head of collections from a private sector bank who had been doing it for 20 years, built a large team. And particularly now, as we go into areas like unsecured personal loans, you go in for new to bank customers, I think it's very important that a collection machinery actually precedes, again, going aggressively into any business rather than succeeding that.
The other thing that clearly has succeeded, and you alluded to it a couple of times, the ability to integrate lateral recruits. I mean, now even the government is advertising for joint secretary level lateral entrance, but that's a new thing. That it has succeeded so much is a surprise.
So in some ways, you always try to do different things and see what works. So there are businesses which are not native to public sector banks, right? There are disciplines which, again, we have not really developed as well. And the question is, how do you actually acquire those businesses? How do you build those businesses? One way is to get a consultant and help you do it. But what we found was it was a far better idea and something that works far better if you bring in somebody, but somebody at the top, because it means that you bring in experience. You also bring in the ability to attract a team around that person who's building that business. And that's something that becomes a sustainable business model.
But won't you disturb the salary hierarchy?
So I think the fact is that the third pillar that I mentioned, performance culture, once you build that performance culture where everybody believes that, look, they do need to perform, there is no option, then people actually start coming to you themselves and saying, look, this is a gap that is there in my capability. Why can't we get somebody from outside to fill that capability gap?
Okay. Oh, that's good if lateral recruits have integrated so well. I'll come to these long-standing issues in a bit because the stock market will also want to hear from you the more immediate performance targets. One, your NIMs. As I said in the beginning, it's a superb improvement. I think it's the best in many years. But is 3.5 or 3.6 maintainable?
So I think there are some structural factors which are at play, which I believe should help us bring about improvement as we go along. There's no doubt that we again at a very fortuitous point in the cycle. But for us, for instance, again, you will find that it is the retail loan growth which has driven growth. So last year, overall growth was something like 17-18% in loans, but the retail growth was 27-28%. And that is something which is significantly margin accretive, in the current context, because corporate loans, again, margins have been under pressure for the last few years. And number two, also, again, because these loans tend to get repriced based upon how the interest rates move. So if we are able to bring the proportion of retail loans progressively up by 2 or 3 percentage points each year, I think this will have a salutary impact on margins as we go along. So that's number one. Within retail loans, the fastest growth has come from unsecured personal loans, which was a new business for us. So last year, the growth was about 100%. And now it has become a significant part of our business. So the book grew from about 10,000 crores to more than 20,000 crores. Now at 20,000 crores, it is about a fifth of what your home loan book is. But because of the margins there, it is almost contributing as much to, again, NII as the home loan book is. So as this grows, and I think we can grow this book to about maybe 4x of its current size before it reaches levels which are with comparable banks. I think that's a big tailwind which is there in terms of margins as we go along.
No, that's where I worry, because Reserve Bank apparently wrote a note to bankers and NBFC heads about unsecured loans and to asking you all to be careful. And everyone is in retail, and once the interest rate starts rising, do you think that your very good record in bad loans, gross 3.7 or whatever, will that be in danger?
So I think the Reserve Bank of India is right to sound a note of caution, but it also depends where are you in terms of your balance sheet. So there are banks which have got retail loans as 50-60% of the balance sheet. For us, it is about 23-24% of the balance sheet. On the other hand, it is corporate loans which are 43% of the balance sheet. You add international of 17%, it is 60%. So the risk that comes to the bank really is from a disproportionate exposure to corporate. And as we increase the share of retail, the fact is we are de-risking the balance sheet because of the granularity that is there in the portfolio.
Okay. All right. So in your case, it turns out to be an advantage. But time permitting, come back to it. But what about growth? Are you seeing signs of the capex cycle? You did 16% in the just ended year. What do you think could be the goal for when Mr. Chand takes over in FY24?
The fact is, you should always trim your sails depending on what is the direction of the wind. So there was a time over 2 years back when corporate growth was not there. So we grew corporate slowly, and that also meant that given the share of corporate, overall growth was also pretty much in line with the market. Last year there was an opportunity which was there because of the macroeconomic conditions. So our stance is that we will try to grow about 2% above whatever the market is, not having a fixed rate of growth, because there's no point pushing at a string, right?
But are you pushing at a string, or are you seeing enough hunger?
I think there is. So it is in what context? If you would take the context of the last year, I would believe there will be a moderation of the growth. If you were to take the context of the last 5 years, I think there's still room for an acceleration.
Okay, so 16 may be tough, but definitely at least 15, 14 would be possible, you think. Okay, the other point is credit cost. I mean, you have answered about asset quality, but this is an excellent credit cost, 0.4. Is that likely possible in FY24 as well?
So I think 2 parts to it. One is, to my mind,
or is there even space to go down?
Yeah, on a normalized basis, I would believe we should factor in about a 1% credit cost. That's what normal should be. Where we are today is because of a very positive improvement in the corporate credit cycle in particular, which continued even through the COVID period. I think it is likely to continue. This also gives us an opportunity. At some point in time in this cycle, the ECL norms will come up. To my mind, the fact where credit costs are gives us an opportunity to have overall costs, including ECL, within that 1% standardized figure, which means that the current trajectory that we see in terms of profitability, that should largely be unimpaired, even if ECL were to come in.
Okay, all right. Mr. Chadha referred to ECL, that is expected credit loss, which is a new rule that Reserve Bank is bringing in. You have to provide not just for loans already gone bad, but loans that may go bad, expected credit loss. We will have more questions for Mr. Chadha on that and on the digitalization experiment in BOB, which has succeeded so much. All that after the break.
IIFL Finance presents IIFL Secured Bonds 2023 with an effective yield of 9% per annum, multiple tenure options, high degree of safety, monthly, annually and cumulative interest options. Issue closes on June 22, 2023. Hurry now. Subscribe today to IIFL Bonds 2023. Visit iifl.com/bonds.
The stigma and lack of period awareness in India have held women back for too long.
I am a teacher, लेकिन मुझे नहीं पता कि मैं अपनी 12 साल की बच्ची से इस बारे में किस तरीके से बात करूं.
The lack of period education and limited access to hygienic sanitary products cause 1 in 5 girls to drop out of school every year once they get their periods.
मुझे लगता है वो किस तरह से डील करेगी इन सब चीजों से, मैं उसको कैसे समझाऊं.
और बात कर सकते मगर ये बात नहीं कर सकते बेटी से.
Whisper designed a special program to break this cycle. For a majority of Indian women, beauty salon or parlor is their safe and comfortable space. They not only get to socialize but often get emotional support from their parlor ladies. So, we train these parlor ladies to teach Indian mothers about the biology of periods.
आज कहीं ना कहीं हमें आगे बढ़ के बताना पड़ेगा क्योंकि लोगों में अवेयरनेस बहुत ज़्यादा कम है.
This program has helped me a lot.
The parlor program is empowering mothers and daughters through period education, clearing their misconceptions and introducing them to hygienic sanitary products to help keep girls in school. You too can help keep our girls in school. Log on to Whisper India's YouTube page and read, learn and share the missing chapter on periods. Whisper, keep girls in school in association with News 18 Network.
The last hour. Anything can happen between the bells. But what happens during the last hour is what matters the most. The biggest market swings, A close-up look at what's driving them and how the investors are reacting. Watch the most seasoned market mavens guide you through the most important hour of the trading day. NSE Closing Bell. At these times, only on CNBC-TV18 and CNBC-TV18.com.
Powered by LIC, हर पल आपके साथ. Co-powered by IBM.
Welcome back to this special Indianomics where we are speaking with Sanjiv Chadha, who ends a fairly glorious term in Bank of Baroda, where all metrics, asset quality, profitability, margins, all of them are at multi-year highs. So what went right is what we have been discussing with Mr. Chadha. Thank you very much for your patience, sir. Well, for starters, digitalization of the bank is something which is very noteworthy. People are talking about it. What do you think are the main achievements here?
So I think we had been making investments in technology for a fair bit of time, particularly I think with Mr. Jayakumar there was investment in a data lake which was there. Two things came along. One was the realization that you need to make sure that the digital agenda touches your customers and transforms the customer experience. The second was, of course, COVID, which again forced us to relook again at our branch network and the centrality it has come to acquire traditionally within banks. So we saw Bob World again as a very important opportunity for us, and we launched that about 1.5–2 years back. I think that's really what has been a tremendous success for us. Today we have got something like 3.30 million Bob World customers. About 5 times as many people use Bob World every day as compared to those who come to our 8,000 branches. And this is something which has huge implications in terms of customer service, but more importantly in terms of costs. I'd also just like to draw your attention back to the merger, where we actually had a very aggressive agenda in terms of cost cutting, which included 15% of the branch network being rationalized. Now, digital really gave us the platform whereby that you could actually grow your business without increasing the physical build in proportion, and that has particular relevant to public sector banks, because if there's one area that where we still lack compared to our competition in the private sector are the cost to income ratios. And that is something that you can only change if you have alternative channels which are scalable as compared to the physical branch network. So I think if we look at Bob World today, our focus the last 2 years has been on penetration. Today about 50% of our non-FI customer base uses Bob World. Now the question is, how can you make them use it more and use it for cross-sell? To my mind, over the next few years we should be able to drive the kind of growth we have seen this year, about 18%, without necessarily increasing the build which is there, and that's a competitive advantage. Even if you look at some private sector banks, to grow business by 20%, they need to grow their cost by 20%.
Yes.
Today the fact is, in the last year, overall industry costs grew by 16%, ours would have grown by 8%. This was the third quarter. Fourth quarter there was a small impact of the wage revision. So I think if we can do that, it gives us a huge advantage in terms of customer experience, in terms of costs, in terms of scalability.
Oh, that's a very big one. I don't think I've heard any analyst report mention this, that, other banks may have to raise their cost perhaps by 16%, where Bob can get away with 8% because of the digitalization. I even had those numbers. Your branches have come down over the 3 years from 9,400 to 8,500. And I believe the number of people as well from about 84,000 to 80,000. So clearly, greater productivity. Okay, before I come to the expected credit loss question, a more generic question across banks. What do you think has succeeded? BOB has been the playground for 2 experiments. One, get a private sector banker, and thereafter get SBI bankers. Because SBI was a class apart, we saw SBI bankers appointed to many other public sector banks. Which is the experiment that has succeeded, or what are the elements in both?
So I think it's important that there's always new capabilities that come in within the bank and within the management team also. So I think the fact that Mr. Jayakumar came in, that brought in a lot of new ideas which I think wouldn't have come in otherwise. First, for instance, the idea of a shared service company, right? So we have Baroda Global Shared Service Company, which has about 5,000 people who work for us, where a lot of repetitive work has gone. If you want feet in the street, you can actually hire it out of there. I think that is something which is very transformative. You alluded to the figures in terms of our staff. I think partly because it has been possible because of the digital agenda, and partly it has been possible because of the fact that we have a shared services company which is there. So I think that was something which was very important. The second was again the possibility that you can get lateral talent from outside in the public sector bank. So I think Mr. Jayakumar started that. It was a great idea, and I think we have taken it forward. That was something which was very good. Third, importance of technology, right? So I think all these things were something which again came in like a breath of fresh air, and I think the opportunity was there for us to capitalize on that. Similarly, again, SBI has great advantages in terms of the soundness of its processes, the fact that its systems work there rather than people. I think those are things that you have tried to build, make sure that there's institutionalization, that there are standards of governance which again can meet the best which are there. So to my mind, again, even as we move forward, for the public sector banks to be able to attract talent, not only again at the level of the operative functionaries, which we have been able to do, but I think even at the top management level is something which is always going to be a positive, simply because of the fact that you get a fresh pair of eyes and a fresh set of ideas.
So I mean, if you are asked for what should be the key takeaways from your tenure, or from both Jayakumar and your tenure, you would say that the government could experiment with private sector heads even in the other public sector banks?
I would say there are maybe 5 or 6 takeaways that I would mention. A, again, belief in what is possible. It is possible for a public sector bank to actually to perform at standards which are the best in the market. So that self-belief is something which is very important. The second, that there is no contradiction between a social agenda and the performance agenda. Today we are very proud that BOB makes proportionately the largest contribution to financial inclusion in the country. We have a 6% market share, a 17% market share in Jan Dhan accounts, right? And there is no conflict between the two agendas. You can do both, right? Third, that you can actually, within the public sector, attract the best talent and retain that. Fourth, that there are some advantages to our business model. Today, many banks might struggle with a 25% attrition. For us, it is just 1 or 2%, because what we do is we get talent at the top, but we have an extremely talented, well-trained, educated workforce which is there in the middle and senior levels. So I think there are great advantages which are there, which we need to just make sure that we capitalize on.
Okay. Oh, that's good to hear. And I mean, a Bank of Baroda man has been sent to Indian Bank, so perhaps the culture will spread, you think?
So absolutely. I think that is, so ultimately again it comes down to the same thing, cross-pollination, being open to new ideas, taking best practices from one bank to the other. So I think Mr. S.L. Jain is doing a great job in Indian Bank, for instance, again, by now starting a shared services company. One business that we did very well, and where again, which gives you the confidence that you can even build new businesses where you're not incumbent, was the cash management business for us. So that's something that Indian Bank is trying to do now. So I think the fact that public sector banks now have the confidence on actually competing on turf which was not their native turf, I think is enormously powerful as an example.
Okay, no, that's very good to hear, that if this culture can also spread out into other public sector banks. But I mean, let me kind of ask a more, I don't mean to offend, but an offensive question. Do you think that a large part of the success that we have seen is also because the times are very fortuitous? RBI went through an asset quality review, and after COVID, we saw clean balance sheets even among corporates. So this is also a positive ambience.
Absolutely. So I think if you were to look at the profitability levels and you were to see where credit costs have gone, I think it's very important. What is important is to see how you can make sure that this continues. So as you said very correctly, there were challenges in terms of AQR. Why were the challenges in terms of AQR? Because you had underwriting challenges. So what we have done again in BOB is to bring in a chief risk officer, who's again one of the most senior professionals from the private sector, because you don't want that the same kind of mistakes should recur. Similarly, again, the fact that we have been able to now deliver growth which in retail loans, because that was the key differentiator vis-a-vis the private sector at 28% faster in the market, means that actually you have been able to do more than what fortuitously you actually have landed up with. I think we should take this as an opportunity for change. Now, what you said is a positive environment, tailwinds, gives us that little bit of space to think ahead and plan for the next 5 or 10 years.
Okay. Oh, absolutely. Now, for a familiar question, what is it that SBI gets right that can be transplanted into public sector banks, non-SBI banks?
So I think it is really what are the advantages that SBI has. One is again in terms of the depth of management, right? Which is, and number two again that you have continuity in management. So I think it will be very difficult for us to get the same kind of management team because it develops over many years. But you can transform that into an advantage by making sure that you attract talent laterally. That gives you again the same advantage of quality, but along with that again a bigger advantage that you actually are open to outside ideas and you can bring in pretty much ready-made experienced talent within the bank. The second is in terms of continuity, and I think that's where the government has done a great job by actually putting in a framework which allows you to have a 5-year term for the CEO and after that a further extension of 5 years. For us, I think the fact that Mr. Chand will be taking over from me over the next few weeks, who has been part of the management team for the last few years, is again something which is very, very important. Now, it's important that we pick up these elements which again have succeeded in BOB, whether it is again the fact that we could bring in a private sector banker, transformational ideas, whether we could bring in somebody with SBI experience, or again the fact that you can get in lateral talent to pick up these ideas and build upon them. So what again seems to be partly driven by circumstances, but partly again by a few good things that happened, is something that can be replicated more widely.
Okay. I hope all these lessons are being learned both at the government level and at the various bank management levels. Thank you very much, Mr. Chadha, for joining us and giving us an idea of what lessons we can draw in what has been a successful experiment in the transformation of Bank of Baroda. Thank you very much for watching this special edition.